Good everybody, and welcome to our webinar today. Hope that you all are enjoying beautiful weather wherever you are, and just want to thank you again for taking time out of your day. I will be sharing some information. Most of you know me. My name is Phil Daniels, and I have our investment analyst Ryan Bouchard with us today for today's webinar.
Hello. Hi, everybody. Hope you're doing well.
So the format of this really is intended to be as interactive as we can make it. If any of you have questions that you haven't already submitted, you can do so via the chat feature, the Q&A at the bottom of the screen that you're looking at. If you mouse over that, you can click on that and it'll give you the opportunity to pose a question to us. We'll do our best to try to answer it. What we thought we would do is we would start with some introductory comments that hit on a couple of questions that we got in advance and provide kind of an overview for what we're currently seeing in the market and the economy, and then really transition into answering your questions and kind of walk through as many of those as we can over the course of the next hour or so. So I guess maybe we just start with kind of a look at where we are. Today, the S&P 500 was up a little bit, closing today at 2526. And just to put that in a context, that's down about 25.5% from the highs that we hit back on March 19th. Just for posterity's sake, that high was 3393 on the S&P 500, so still a ways beneath that, but not as bad as things were. That's up about 15.3% from the lows that we hit back on March 23rd when the S&P 500 was down at 2191, and then as of today's close, if you look at, what's that look like year to date on a price only basis, all of these percentages are price only. As of today, we're actually down 21.8% on the S&P 500. And depending what data you rely on, the yield on the S&P 500, the dividends from those companies is still running maybe 2 to 2.5%. Some estimates anticipate that there will be some dividend cuts, and so that might be closer to the 2 than the 2.5%. But so at any rate, the question that a lot of people have been asking is, so when we hit 2191 back on March 23rd, was that the low? And it's a very reasonable question. And the honest answer has to be, well, we don't really know. It could be. And if it was, then congratulations, we're now in a new bull market, or we're not. And so, we think there still is a very real possibility that we could retest those lows, and we'll talk a little bit around why that might be the case, but it's not a foregone conclusion that we have to take out those lows and hit new low markets, which would mean we're still in fact, the bear market that started, back on February 19th now. So that's just kind of a context of the US market, what it's done, where it's gone. But wanted to spend a little bit of time talking about, so what does that really mean? And maybe I'll just let Ryan speak for a couple of minutes about some of the data that he's seen about valuations and where earnings are at this point, and maybe even break that down in a little bit more detail around the different sectors, which is part of a question to somebody that sent a question before the call asking, well, what happens if this just goes on, and what do we do about that? And I hope that Ryan's data will help maybe shed some light on that.
Yeah. So thanks, Phil. I want to share a couple of charts here, and hopefully now you can see, Phil, you can see this slide on here, right? Oh, there we go. Now is that showing up for you? Yep. Okay, so this shows the S&P 500 at different inflection points since 1996, and you can see that we ran up into the late 90s. Here's kind of where the tech bubble started. We start to run down here. This was 9/11, falling quite a bit there, and then after the September 11th attacks, we had kind of the corporate accounting scandals, Enron and WorldCom. And things kind of bottomed out here in late 2002. Ran up pretty good until we got into the beginnings of the great financial crisis. Fell again pretty hard there, but then bottomed out in March of 2009. And you can see this is where we've, we got way up here into February 19th, and that was the longest bull market in history. And it didn't look like anything was going to derail us. And then from out of nowhere comes a virus. We are now, as Phil said, we're about 25 or so percent from that high, 25.5, I think, percent from that high. The good news is that that's brought our PE multiple, that's kind of the valuation, when you're trying to determine whether or not stocks individually or stocks in terms of the overall market, whether they're expensive or whether they're cheap. This is kind of what you look at is what is the price to earnings ratio. And so at 14.9, you can see that that's much lower than where we were a couple of weeks ago or a month and a half or so ago at 19 times earnings. If you look at what these valuation multiples have done over time, let's see, that is, there it is. Here's 14.9, and this was as of the close yesterday, so this doesn't have today's closing price in. It'll be a little bit higher, but you can see that the 25-year average is 16 times earnings. So we're comfortably below average in what you might consider the kind of the cheap range. But it's suffice it to say, you go back here to the last 25 years or so, and you look at what I found really interesting in this was in 2002, after 9/11, after the corporate earnings scandals, at 14 or so times earnings is pretty much where the market bottomed out. And that's where investors, institutional investors, retail investors, where that was the point of inflection where they thought these prices are just too cheap. Like these companies do not deserve to trade at such cheap multiples. And so that's kind of where we're at today at 14.9. Phil, you kind of alluded to, okay, well, that's the multiple. So that's the multiple that investors are paying on earnings, but our earnings, where are those earnings estimates now? For sure, you think that they have gone down, and they have. So this is a good, FactSet is a good source for what the overall S&P 500 earnings are expected to be. Now, these numbers come from analysts. You can see here's late 2012. Here we go. The end of 2012, we were looking at, they thought for the calendar year 2020, so for this year that we're in right now, that earnings were going to be up about 9.1% on a year-over-year basis. So 2020 earnings per share would be 9% higher than they were in 2019. You can see as we progress, we fast forward the tape, earnings estimates come down, they come down, they come down. And now here we are, this most recent week, analysts are now projecting earnings for 2020 to be negative compared to what they were in 2019, so down 1.2%. I think it's interesting though to figure out, okay, is all of the pessimism baked into this number? And that's kind of where the question, it's kind of what the question is getting at is, are we at a bottom? Do we have enough baked in yet? And if you can zoom in on these numbers here and figure out what sectors, as Phil talked about, what sectors are pulling this overall number lower? Look at this. That's the S&P 500 earnings on a year-over-year basis for calendar year 20, and you can see that energy earnings are expected to be down 62%. So I think it brings up an important point. Now, energy is obviously, this is impacted by the fact that the price of oil went from, you remember in very early January, I think it was January 6th or 7th, when we had pulled off the assassination of that Iranian military leader, and Iran threatened us with a return attack, and the price of oil shot up, and I think it closed above $62 a barrel. Well, last week, we got down below 20. I think the spot price of oil over the past couple of days had been $14 a share, or $14 a barrel. So, if you think about an energy company that's going to sell oil, if they were 3 months ago able to sell oil at $60 a barrel, and today they're only able to sell it at 14, 15. Today I think it was up quite a bit. It was up to about 20, 25 or so. So my point here is just that some of these numbers here are still stale, and that maybe that negative 1.2% overall number for the year might be a little bit pessimistic. You can see some of these other sectors like IT, healthcare, communication services, real estate, those earnings are still expected to be higher than they were last year. So I think it's important to keep it into context here. Phil, was that's kind of what we were getting at there as far as that goes.
Yeah, thanks for sharing that, Ryan.
Yeah.
If you want to discontinue the screen share there, that'll
Sure, yeah.
maybe let folks see our smiling faces a little
Okay.
a little bit more. But no, that was good content that we thought was relevant for you to see as it related to the valuation of stocks here in the United States. And we wanted to have that as the backdrop as we talk about what is going on with COVID-19 and how is that impacting the economy. One of the questions we had was, what if this goes on? And we're very optimistic that it will not. And we have another question here questioning, the magnitude of this bear market and how that magnitude compares to others and the speed of this. And so it's an excellent question because this has been unprecedented in terms of how quickly we declined from those prior highs into bear market territory, which is defined as a 20% pullback in stock prices. And so we saw that happen very, very quickly. And, the magnitude, though, really is fairly representative of a bear market. And so I think this is the 12th bear market that we've had since World War II. And this is very much in the range of what we would call kind of the open or the kind of average and normal type of bear market that we might see. Now, again, while I made the comment earlier that we had that low water mark back in March that may have been the lows, we don't know that at this point. And that's the interesting thing about bull markets and bear markets. The beginning and end of them are not known until you have enough data to look back and to see where we are. So maybe addressing another question. Somebody sent in a question ahead of time. And again, if any of you have questions, feel free to type them into the Q&A and we'll try to get to as many of those as we can. But there was a question about the interconnectivity between our economy and the Chinese economy and the amount of dependency that we have on the Chinese to manufacture certain goods and whatnot. And whether or not some of that manufacturing might in fact come back to the United States as a result of this. And I'd say that's a reasonable question. And in fact, coming into 2020, I think having gone through the tariffs that we had in 2019, there have been a lot of supply chains that have changed a little bit as a byproduct of that. And so, we could be looking at a scenario where some of the supply chains have already begun to change and more of them might be changing as a byproduct of the coronavirus. Some of the pharmaceutical products that have been produced in China that, there's a concern that they might be in short supply. Those are things that you definitely could see some of that coming back. But I don't think we're going to get into a position where there is not some level of interconnectedness between different economies around the globe. I just think that it probably will shift a little bit.
And Phil, I think that's a good point. Something that we had seen, I think we're in a much better situation with regards to trade with the Chinese after going through all of the tariff arguments that we went through. Over the past year, we had seen a lot of economic data from, their manufacturing sector had been flat to declining for most of the past year. And what you saw was a lot of trade-off indications. You would see manufacturing sector from the Philippines, a lot of those countries right around there, right around Vietnam was a beneficiary of this. You saw that their manufacturing sectors were growing much faster and had seen a really good bump in activity. And that was explained by a lot of, kind of, they would call it new export trade deals. So meaning, that supply chains were moving out of China, that companies were setting up shop in the Philippines and some of those neighboring countries to fill the void that we were not buying from China anymore. So I think, having gone through that process was definitely helpful. And you're on.
I'm looking at another question here, which is really another excellent question, and that is as it relates to the amount of stimulus that the Fed has put into the package, into the recovery package right now. Are we going to be looking at a significant impact from that? The question is, hey, look, all of this stimulus package, all of this debt that we're incurring in order to provide this stimulus, that's got to end up impacting the market and the economy, and it probably will. And one of the things that's really helping at this point are that the interest costs related to the debt that we're taking on are incredibly low, and so that's going to help us out for now. And then the other question is, well, what percentage of our GDP are we actually devoting to debt service? And we have actually been at higher levels in the past. The nominal amount of debt is higher than it has ever been, but the percentage of GDP devoted to the service of it is still manageable at this point. An ancillary question related to that we received in advance of today's webinar was, what might the inflationary expectations be? And that's a fascinating issue. We look back to 2008, 2009, when the Fed expanded their balance sheet dramatically to try and deal with the financial crisis and inject enough liquidity into the system to keep the economy rolling through that. And there were concerns then that inflation would be a real problem with the Fed carrying a balance sheet as large as they were. But what ended up happening is we never really saw the velocity of money return at the same level as we'd had in the past. And so we didn't get as much inflation. And in fact, for the last decade, the Fed has been pretty focused on trying to have enough stimulus to actually create a little bit more inflation. They've been targeting 2%, and they've been having a hard time getting us to there. And so there are a couple of reasons for that, and questions that folks have been asking about, well, why is that the case, and what might be happening to be a counterbalance to that? And that might actually be a relevant topic for the current monetary stimulus that we're seeing here. And that is that there have been some things that have occurred that are creating a bit of a deflationary pressure as well. And so some of those things that we would point to is really either technology and things that have happened that are allowing us to increase our productivity and our efficiency significantly without necessarily having the cost increase. One of the places that people have really been focused on is how in the world, prior to the economic impact of the coronavirus, how in the world have we had employment as low as 3.5%, but not really seen that manifest itself in wage inflation, and that then leading to broader inflationary pressures? And the arguments that we've seen for that is, well, yeah, there have been these other factors that have pushed back the opposite direction and might well be a deflationary pressure for some time to come. And in fact, some people would actually argue that the Fed might actually be looking at what do we need to do to prevent deflation? Ryan, do you have some additional thoughts on that point?
Yeah, I would just say when you look at it in overall inflation numbers, you're looking at CPI, so the Consumer Price Index. A large portion of the CPI number is comprised of housing, and that includes rents. they make an adjustment and try to include rents in their rental equivalents. And I want to say it's about 40% of the CPI number is housing / rents. And that has, over time, that's kind of averaged around 3.5% or so. So you've got this upward bias in inflation by 3.5%. If that means if 40% of the overall inflation number is already at 3.5%, then then that other 60% of the equation has to be lower and has to be pulling the overall number down for us to be running at less than 2% for the past several years. Phil, what you said about the Fed targeting 2% inflation, yeah, and the fact that they haven't hit that in so long, they've also said we may need to let this run hot for a while, meaning we're not going to stop once the economy gets to 2% inflation. We might let it run over 2%, maybe 2.5 or 3% for a while, just to try to pull that overall long run average back up to 2%. Yeah. You mentioned some of the other components of inflation, and I would say even when you try to strip out energy, so analysts will talk about inflation X energy, and what that does is it takes out the price of oil, takes out the price of coal and things like that, but you can't fully strip out the price of energy from all the other goods in the economy. If you think about it, the transportation of every good in our economy, whether it's eggs or milk, or even if it's a box delivered to your front door from Amazon. So whether you buy it from a brick and mortar retail store or whether you buy it from an online store, the cost of transportation is a large component in the overall cost of that good. And so if the price of gasoline goes up, it's going to impact the overall inflation number. Likewise, when the price of gasoline comes down, as it has now, with the price of oil coming from, going from 62 to, 25 now, that's a huge deflationary headwind that you're going to see. The price of trucking has gone way down. So, yeah, I don't see inflation being a concern right now. It doesn't mean that it won't be in the future, but like you said, when the Fed threw lots and lots of money at the problem in 2008, the same exact thought happened, but it hasn't come to fruition yet.
Yeah. There's another question here that we just received about the likelihood that we move into a negative interest rate environment and what that could mean. I think the Fed has really kind of communicated that they don't want to go into a negative interest rate environment. They're doing everything they can to provide stimulus without necessarily having to resort to negative rates. And I think there are a couple of reasons for that. One, you've seen negative rates in other parts of the world, and the theoretical benefit that they thought that might produce has not really materialized. Those economies have not had robust growth as a byproduct of negative interest rates. And there are very real concerns that I have and that I've seen other folks write about, that negative interest rates could have a significant impact on the banking system. And you really don't want to be in a position when you're in a period of any kind of economic distress of undermining the integrity of the banking structure. So I think the Fed is very, very hesitant to go into a negative interest rate environment. If they did, what would the implications be? The implications would be we'd have to take a real serious look at the value of fixed income in a client portfolio, and it would probably drive us into a situation where if you're really looking at a negative interest rate, you might have to more heavily value actual cash. I know if my bank told me that they were going to give me a negative yield on any cash I held, the amount of cash I was willing to hold would go down precipitously, which would be the contributing factor to undermining the integrity of the entire banking system. I really think that's something the Fed is going to great lengths to avoid, and they're doing that by throwing a lot of additional capital at the financial markets, trying to ensure that there's liquidity. Couple of additional thoughts that we did want to share with you about the economy, because I mean there are absolutely some meaningful economic impacts from this current challenge with the coronavirus. Specifically, we saw the jobless claims come out today, and they were unprecedented at 3.3 million, which is the largest number we've seen since a number that was just shy of 700,000 back in 1982. So 4 times the previous high water mark. That's staggering. That brings us to 6.6 million, and the expectations are largely that's going to increase. So we expect to see unemployment go up. As Ryan alluded to before this all started, we were looking at unemployment at 3.5%. Some of the expectations we've seen is you might see unemployment as high as 10% in April, which would actually be reported in May. May 8th, I believe, is going to be the unemployment report for April. And by mid-year, Goldman Sachs had a forecast that we could see unemployment as high as 15%. And there are other folks that have even projected higher unemployment numbers before this is all over. However, the prior question about the speed and severity of this market reaction is also akin to the severity and speed of the economic drawdown. And that is that, there is an expectation that this is going to be a potentially one of the deepest recessions we've seen, but also one of the shortest recessions we've seen, because it is in some ways a bit unique in that it wasn't brought about, as many recessions are, by interest rates moving up and oftentimes the Fed trying to fight inflation. Is increasing rates, and at some point the rates get high enough that it actually does trigger a contraction in the economy or a recession. This wasn't caused by anything like that. The slowdown in our economy and these unemployment numbers are directly attributable to the tactics being deployed, social distancing, stay-at-home orders, et cetera, to try to flatten the curve, to reduce the numbers of new cases of the coronavirus that we're dealing with, so that our medical infrastructure can keep up with the people who are impacted. And so the expectation is that when the COVID-19 kind of runs its course and we see the numbers of new cases dissipating, you'll see businesses opening back up, and many of these people who are filing for unemployment benefits right now will be able to go back to their jobs, provided that those businesses are still there for them to go back to. And so that's one of the major factors, I think, that folks are watching and asking, all right, is this going to be a short enough period of time that the majority of those businesses will still be intact? I saw one forecast that, if in fact people are back to work in a relatively short number of weeks, you might see 1% to 2% of businesses actually not be able to reopen. But as that continues, you would see a higher and higher number of those businesses impacted so that they couldn't reopen. The silver lining even to that, though, is the root demand we think is still likely to come back. And so I'll just use my own circumstance as an illustration of this. I and my wife, like many of you, enjoy going out to eat. And once we are no longer at risk of becoming infected with the COVID-19 virus or transmitting that to others, then we're going to want to go out to eat again. And I hope that our favorite restaurants are still open in business and anxious to welcome us. But if they are not, we will take our business to those that survived, or maybe even to new ones that are opened, again, creating opportunities for the economy to recover very quickly, and for those people who lost their jobs to find employment, maybe with different employers if necessary. So I think there is demand, and that's kind of manifest by some of the forecasts we're seeing. I don't know that Goldman Sachs necessarily has this figured out better than anybody else, but they've been very kind at providing us data on a weekly basis and updating their assumptions. So I'll just share with you the forecast that we received this week. That is that the first quarter GDP numbers are going to show a 9% contraction. That's an annualized number. And that is pretty dramatic and incredibly fast, but it's to be followed, again, their estimate, in the second quarter with a decline of 34%, which is just staggering. Really, the brakes have been put on the U.S. economy in many respects Again, certain sectors more so than others. Travel and leisure definitely heavily impacted. The hospitality industry heavily impacted. But the forecast for earnings that Ryan showed you earlier that showed still EPS, earnings per share growth for certain sectors, specifically tech and healthcare, et cetera. There are parts of the economy that are still functioning and even still growing. The silver lining or the positive side of that is Goldman Sachs in their forecast expect the third quarter GDP numbers to actually be positive 19%, and by the end of the year to have had a 6.2% contraction over the entirety of the year. I would say that even that radical decline that they're forecasting for the second quarter, they really expect to be front loaded. Right here, right now, April is where the majority of that is. They think by the second half of May and into June, you'll start to see economic activity picking up as we begin to get back to normal with these new cases being identified, hopefully flattening. The fact of the matter, though, is the number of new cases and sadly, the impact on the number of human lives that are lost. As President Trump said earlier this week, we've got a really tough couple of weeks ahead of us, and the numbers are going to be really, really tough. I've seen all kinds of different forecasts, and they have changed radically week to week as they get more data. I do think with respect to the virus itself, certainly as the medical community in the United States and around the world makes more progress in research and determines how to treat it, how to identify it, how to test more effectively for it. Those are all things that help us get closer to a sense of normal economic activity. But for the next couple of weeks, there's going to be some really negative numbers that you'll be hearing on the news. But really, as those pharmaceutical interventions and the testing becomes more extensive, when they develop an antibody test where we can figure out who actually has antibodies and can be around the virus and not become infected, those are all going to be positives that I think, remember, the market is a forward-looking pricing mechanism. And so the market doesn't just look at the current news and price based on that. It looks at the expectations for what's coming next. And as the number of cases identified plateaus and begins to decline, the market will be looking well past that towards these quarters of accelerating economic growth into the third and fourth quarter and all of 2021 that should be pretty positive. The other thing that we would add, again, if any of you have additional questions, please click on the Q&A towards the bottom of your screen and type those in. We'll be happy to answer those. But there are a lot of technologies that are getting utilized right now that that really kind of point us towards, there are opportunities that entrepreneurs will be taking advantage of, and whether that is things like this call. We as a business have done more Zoom meetings in the last 2 weeks than we've done in the history of our firm. Now, we're anxious to get back to normal and be able to meet with all of our clients face to face and to spend time with them. But is it likely that more businesses will conduct more business using Zoom or other video meeting technologies on a going forward basis, or will it potentially just accelerate what was happening naturally anyway? Yes, that's a very real possibility, and that extends to other technologies also, like telemedicine and all kinds of new innovations that are coming about as a byproduct of this. So
yeah, Phil, I think we did have a new question come up. One of them here was, so what should we be doing with our investments? We talked about the PE ratio. I'll come back to that for a second. And I apologize if I fade in and out here. I keep getting warnings that my internet connection is unstable. So it's better than the computer telling me I'm unstable. But as I look at, so when stocks go down, the stock market has never gone to zero. It's important to keep that in mind. And there's a reason that the stock market never goes to zero, and that's because companies in the United States continue to sell stuff to people. So let's just take Procter & Gamble. Let's pretend like the S&P 500 is just one company. It's Procter & Gamble. And if nobody ever needed toilet paper again or never needed toothpaste again, then yeah, Procter and Gamble would not be able to sell anything anymore, and they would have no revenue and they would have no earnings, and so the stock price would go to zero. Well, there's 499 other companies in the S&P 500 that are doing similar things, selling different products, whether they're consumer discretionary goods or consumer staples or energy companies or telecom companies. We're having a Zoom call on the internet. Everybody's paying an internet service provider. Another warning that my connection's unstable. So the point is that when the price of stocks go down, the expected return over time actually goes up because at what price you purchase a stock or buy into the stock market, that matters to your future. Buy it at a lower price, you can expect to have a higher return over time. And I want to share another slide here. Here. This shows based on the forward PE, and this chart over here just shows you what are the next 5-year returns based on the forward PE, the starting price to earnings ratio. If you look over here, here's the PE. Here are the PE ratios right here. So we're at 14.9 times. So we're right about here. Now, as you go lower, as stocks continue going down, the valuation multiple goes down. But what you'll see is that this trend line here, which basically shows you what happens with this data set, it means that every time that the PE ratio goes lower, that you actually go up on the y-axis here on your expected subsequent 1-year return. So that makes sense intuitively. As stocks get cheaper, the expected return over the next year goes up. Think about what happened in let's see, it was 2018 where we had a bad year, and 2019 was an explosive year. And we've had a rough start to the beginning of this year, but when the economy comes back, you can expect a pretty good rubber band, a pretty good rebound effect. Same thing can be said for over the next 5 years, is that as the stock market goes lower in valuation and you're paying lower prices for stocks, your next 5-year return, they go up. Your expected returns go up. So, again, back to the question, what should you do with your investments? That's why we preach, stay the course. Now there are some tactical things that we can do here and there where we're capturing tax loss harvesting in taxable accounts and things like that. But for the largest, the largest dials, as Todd and Phil sometimes discuss, your equity to fixed income ratio should stay right about the same. You rebuy into weakness. You can kind of rebalance your portfolio. So when stocks go down, they've become a smaller part of your portfolio. So sell what has become a larger part of your portfolio, which is fixed income in this case, because you're selling them when they've gone up in value, and then replace that with a little bit more stock investment. Take advantage of the fact that stocks have gone on sale. So I think that's kind of the answer to what should we be doing with our investments right now.
Yeah, and I would maybe just add one piece of data to it, just to kind of put that into perspective. Why does the discipline of rebalancing and buying stocks when they're down add so much to a client portfolio? And really, volatility is a way of measuring risk. There are other types of risk, but volatility is one way of doing it. And folks oftentimes don't really like volatility, but volatility really creates the opportunity to do something productive if we as investors react appropriately to it. And so the statistic that I saw this week was, this is the 12th bear market since the end of World War II, and the average 1-year return in the first year following a bear market is 39.2% for the S&P 500. So if the recovery coming out is, now again, it's coming from a depressed level, I get that, I understand that, and it really is in many cases just helping us get back to where we were before. I'm not saying you're going to be 39% higher than where you were, but we're making decisions about what to do at this point in time. And if we're near the point of putting in lows for this bear market, the potential from here can be pretty dramatic. So I agree with Ryan's general commendation that at this point, what we strongly encourage is to continue to implement the strategy that you each have in place for your individual portfolios with a level of discipline that will guide you towards selling the things that have done relatively well to buy the things that have declined the most, so that when they ultimately recover, you benefit from that. There was another question here about kind of a portfolio related question about, what does this mean in our retirement years with limited additional income potential? That is an excellent question. We have been running in our internal models, we've been running lower expected returns from the fixed income portion of client portfolios for a while now, because yields have been at these lower levels. And so I don't know if there's anything that you really need to do to modify that. There are some folks who've talked about maybe embracing dividend paying stocks as a proxy. And I would say this environment is an exact indication of why that is a really, really bad idea, because the risk that you embrace when you buy dividend paying stocks is materially different than the risk you have when you have high quality short and intermediate term bonds. So even if the income that you're receiving on those bonds is diminished, I still think that they provide a very important stabilizing component to an overall portfolio, which allows you to do the rebalancing that Ryan and I have mentioned. The counterbalance to that, though, is when bonds are paying very low yields, they almost always accompany environments that have very low inflation. And so your real return, how much you actually get to keep after you account for your eroded purchasing costs from inflation, is a combination of those two things. So if inflation starts to heat up, as one of the prior questions indicated could be a concern, well, those yields on fixed income will likely pick up as well, and we'll get compensated more richly on that portion of the portfolio in that season. There are a couple of other questions that we do want to make sure we get to here. One asked about the CARE Act, which I'm glad you asked that question. We wanted to mention that the CARES Act was recently passed, and it has a lot of implications for small businesses and a lot of implications for people who lose their jobs, et cetera, et cetera. But from an investment standpoint, there are a couple provisions that are really, really fascinating. One in particular is that they have eliminated the requirement to take distributions from retirement accounts in 2020. So required minimum distributions, or RMDs, have been eliminated for 2020. And so what we're doing is we're evaluating each individual client situation on a case-by-case basis, and we'll be in contact with each of our clients to discuss how that actually impacts it. For some people, it's not going to matter. For some people, if the only investment accounts they have are IRA assets and they have a need for income, well, they're still going to need to take money out of that IRA. But for people who have a trust account or have another access to liquidity that could meet their spending needs, this could be a real gift. And there's some fantastic planning opportunities that it creates that we're looking at, again, on a case-by-case basis, try to figure out what are those opportunities for each individual, and even looking into those people who have recently taken some distributions out of their IRAs. Is there a step that we can take to return those assets? And in some cases, there may be. Right now, it looks like the IRS is going to need to issue some further guidance. This is brand new, but that's something that each of you can expect us to be talking to you about either in the very near future or certainly as part of your upcoming meetings with us. Another question here about the governmental response and government leaders' response to reopening the economy. And, will they do it too fast? Will they do it too slowly? What is the mix there? And obviously, it's been interesting to watch how different jurisdictions have embraced that. Those of you who live here in St. Louis, both St. Louis City, St. Louis County, did in fact issue a stay-at-home order. And so our business, we're talking to you from our respective homes because we're trying to comply with that to flatten the curve and reduce the spread. But the question really is that, will the leadership reopen the economy soon enough to limit the economic impact? And I hope that each governmental agency that is making that decision will allow the data to define that and will yield to the guidance of the infectious disease experts and what they think is safe or not safe. I caught a little bit of a news story while I was eating lunch today that apparently the CDC is reevaluating whether we should all be wearing masks when we leave the house. Now, from the beginning of this, they've been telling us, nope, you don't need to do that. You only need to do that if you are sick. But they're looking at the data from some of the Asian cultures where wearing masks is more common and saying, wait a minute, is that part of what helped them bring it to a sooner close? And so I don't know. I'm not an infectious disease expert. I'm trying not to leave the house very often myself. And, if they tell me I should wear some kind of face mask when I do, I'll ask them where I can get one, and I'll try to do that. But whether they reopen the economy is going to be interesting. I think there's certain parts of the administration that would very much like to, they recognize there's an economic cost to this, there's an impact, and they'd like to reopen it as soon as they can. But they're trying to do that in a way that is also responsible. You've looked at states like Florida who did not issue a statewide stay-at-home order until yesterday, and finally yesterday they did. The discussion that was coming out of Florida was, look, our state is very diverse, and we have high population density areas for whom it might make more sense to have a stay-at-home order, but then we have other parts of the state. They were talking specifically about the Panhandle, which has a lower population density, and individual communities that might be more severely impacted economically by going to a stay-at-home order, that they thought maybe that there was an individual community, individual county response that might be more appropriate than an entire state. But then they ultimately did go to a stay-at-home order for the whole state. I saw a graphic today that I thought was really interesting. I didn't have a state-by-state accounting for who had issued stay-at-home orders and who hadn't. But the graphic I saw had 6 states that had partial stay-at-home orders, something like what Missouri is in right now, where both St. Louis and Kansas City have some version of a stay-at-home order, but it hasn't been dictated that it was a statewide stay-at-home order. So there's 6 states like that. There are 5 states that apparently haven't issued any kind of stay-at-home restrictions, but that then leaves the other 39 states who have all issued stay-at-home orders at present. And so, it's interesting to see how each individual state, each individual city and county are dealing with this. And I think what we're likely to see is that there will be some, when you look at the United States in total and you look at the different hotspots, they're at different states of evolution throughout this process. And so you keep hearing a lot out of New York, and the number of cases and the number of deaths coming out of New York itself, they're probably further along in their process than some of the reports that we've been seeing about either Detroit or New Orleans, or maybe some of these other hotspots that are not as far along. And so the question would be, how would you be looking at that from a stay-at-home order when you've got different phases of progress through the disease in different geographic areas? So it will be interesting to see. I think right now the indication is, largely the stay-at-home orders look to be intact through the end of April, and then it'll be data dependent going from there. Another question just came in about sources for commentary on the market. Obviously, we hope that you would depend upon us to be a good source of information about the market. We're going to try to communicate with you through written format and through webinars like this as often as we can. Sharing economic thoughts, sharing market thoughts. Other than that, there are a handful of economic outputs Ryan, I might ask you, is there anything, I know Ryan just digested a tremendous volume of economic thought from a variety of sources. Do you know of maybe one or two that would be readily available to individual investors?
You know, we've recommended Brian Westbury's stuff in the past. You know, pretty reliable, consistent source. He's been labeled a perma bull in the past, but you know, I think the problem with labels is that you get some people who are, you know, they may have vested interests, and so you know, you hear a lot of these perma bears. Peter Schiff is the name of one guy, and he sells gold online. And guess what? He's got the Schiff report, and so he's always trying to scare you into buying gold. And so for the past 12 years, he's been talking about the double dip recession. And when that never happened, it was, you know, this was all built on, you know, it's a house of cards, and it's, you know, the Fed intervened to try to get this bull market going. And so it's so, you can't listen to a lot of the doomsday people. There's another one that's pretty bad. He's Dr. Doom, his nickname, because he's always calling for the next Great Recession. I think all of those types of people, you know, they've got a litany of reasons for why, and they all sound very intelligent as to why, you know, what's the next thing that's going to cripple this economy and is going to trip us up, and we're going to, you know, all be living in caves again. But the fact is that, you know, I just, you know, like we covered earlier, that there are so many vested interests in making this work and making capitalism work, and you can't say that you know, S&P 500 companies are going to stop producing stuff and stop selling it to people who have money to buy it. And Brian tends to be one of those types of people, Brian Westbury, and I'm sure we can send out a link to his site. But he tends to be one of those more even-keeled, middle-of-the-road type of people who are just, you know, don't believe all the negative stuff that you hear out there. You know, corporate America is doing fine. He'll admit, you know, here and there when things are troubling him. You know, government debt is one piece where he's concerned about it. We should have, by all accounts, used the past 10 years to pay down a lot of our government debt. But we didn't, and so here we are. The good news is that no other country in the world did either. And for those, you know, for that purpose, debt and foreign exchange tend to be a relative game. And so it's like, you know, if you think that America has a lot of debt, look at Japan. Japan's got a whole lot more debt. Our currency is as stable as the Japanese yen, actually more stable than the yen. Our currency is more stable than the euro, and currency is kind of, that's the release, you know, the relief valve, you know, for global debt. So that's your barometer as to whether or not somebody is way in over their heads. Their currency would go down. But the U.S. currency is stronger than really any currency in the world. That's why we're the reserve currency, you know, and everybody keeps asking, you know, when do we lose the reserve currency status of the world? And you know, you look around at all the other options. Do you think the UK, the British pound is going to take over? No, they're not nearly as big of an economy. Is the Chinese renminbi? No, they don't have a free market economy. So, you know, I think Brian Westbury, in short, the answer is Brian Westbury's stuff, and we'll send a link to that.
Yeah, we just got another question here. This is, the question is that, hey, we heard that first quarter estimated tax payments won't be due until July 15th. You know, I think most of you are probably aware of the fact that tax filing is actually extended to July 15th. Tax payment for 2019 is extended till July 15th. And in fact, the first quarter estimated payment was also delayed until July 15th. When they did that, they didn't quite pick up on the fact that the second quarter tax payment will actually be due before July 15th. It's due June 15th under normal circumstances. And so right now it does look as though you will make your second quarter estimated tax payment before you make your first quarter estimated tax payment or make your 2019 tax payment. The expectation is that that won't hold, that there will be an adjustment to second quarter, whether it'll be shifted to July 15th to coincide with first quarter or whether there'll be a different date. Don't really know yet, but yes, right now today, your second quarter payment is due June 15th. Your first quarter would be due July 15th, but we do expect that to get modified. So another thought that we wanted to share with you today, if the market falling as far as it did, as fast as it did, caused you some level of concern or anxiety, that's perfectly normal. And we just wanted you to hear from us that having those levels of concern when the market drops that far, that fast, is perfectly normal. That is, you know, we've spent a lot of time studying behavioral finance. How do humans react and why do they sometimes make decisions that are not in their best interest when it comes to financial decision making? And it is natural. There's a graphic that I wish I'd have thought in advance to have as part of this, but it's kind of a sine curve, if you will. It kind of goes up and down, and it's kind of a wave. And it makes the point that when markets are going up, people generally feel pretty good. They're making money, and sometimes a rising tide lifts all ships. So even if they have some subpar investments, they're still making pretty good money, and they feel good about it. And in that environment, they're more willing to commit more cash to reinvest, to go ahead and buy stocks while things are going up. And the chart makes an interesting point that when the market is going up, people felt pretty good generally in late January and into early February when we were hitting all-time highs on February 19th. And they were willing to invest cash and to buy at what now in hindsight was a market high. And at a point which actually did have a lot of risk associated with it. Well, as the markets come back down, people begin to be a little bit concerned, and they begin to question their strategy. And they say, you know what, I thought I was a long-term investor, but I'm just not sure these markets are for me, or maybe certainly not the structure that I had. I'm watching my portfolio value decline more than I'm comfortable with. And as the market weakness continues and it gets worse and worse, people eventually begin to capitulate. They begin to say, I just can't take it anymore. I need to get out. And they sell oftentimes at a market low or near a market low. It's awful hard to pick highs and lows. It's certainly not anything anybody does intentionally, but they just reach a level of anxiety. And I share the story of a client we had back in 2008, going into 2009, who I had the opportunity to spend some time talking to, I think it was late February, spent about 3 hours talking through, the benefits given the market history and trying to share some of the thoughts that we've shared over the course of the last couple of webinars with you all. And I got a very sweet call the next day thanking me for all the time, but said, I just can't take it anymore. I have to go to all cash right now. And we were sad to hear that, because that did bring to an end our engagement with that client. We couldn't in good conscience be an advisor to somebody that was going to all cash with the market down as much as it was. But at that point in time, we felt strongly that was going to be very, very harmful. Well, now, hindsight's 2020. Now we can look back and go, oh my gosh, you were about a week and a half to 2 weeks in advance of the market low before one of the strongest rallies our market's ever seen. And, the point is, when the market goes down, it's natural to have that level of concern. And that's why there is so much value in an investment policy statement where you have decided in advance, here's what I'm going to do when things look really scary. And if you can distance yourself from kind of that very normal behavioral impact and allow yourself to make decisions that are productive rather than destructive, you give yourself the opportunity to have a quicker recovery than otherwise would be the case. So that's what we do. I mean, we're constantly doing that. I love sharing the story, and I'll apologize to Ryan and anybody else on this call who's heard this story before, but it's the story of my daughter. We had an opportunity to go on a family vacation years and years and years ago, and my daughters were excited about this because this was the first time they were going to be able to actually ride the big roller coasters. We were out in Colonial Williamsburg, and after going to all the historical sites for 3 days, I think it was, we finally went to Busch Gardens, Williamsburg, and we made a beeline to this roller coaster that met all of the requirements, which was that it didn't go upside down or it didn't have any corkscrews. And so we get in line, and they're as excited as they could possibly be. And we're going up the hill, and they're looking left and they're looking right, and they can see where our car is parked, and they can see the hotel we're staying at. And they look to the right, and the whole park unfolds before them. And they're excited about, let's go do this, let's go do that. And Ashley, my older daughter, is sitting to my right. My wife, Laura's right in front of me, and Lexi, my younger daughter, is sitting to Laura's right. And when we reach the peak of the hill, we drop, almost a straight drop. And I feel this little hand grab my right forearm and just squeeze. And I glance over and I realize my daughter is not having fun anymore. And so I did everything that a dad can do in that environment, recognizing we're 45 seconds away from the end of this ride that she doesn't want to be on. And so I'm smiling and laughing and trying to communicate to her that dad's having fun, hoping that she'll pick up on that and try to enjoy it a little bit. Long story short, the roller coaster it comes to an end as we come around the last curve, and we get to that spot where they kind of slow you down and stop you, but you're not at the station yet. So that you get that tick, 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 psst, and we come to a complete stop. And my daughter turns and looks at me, and she says, and I'm quoting word for word, I'll never forget this, "Daddy, I do not want to do that again." Well, fast forward, my daughter is now a rabid roller coaster rider. She absolutely loves it. In fact, even later that day, she got on another roller coaster and tried it out, just so long as it wasn't quite as big as the one she'd gotten off of. But the reason I share the story is because there's a bit of a parallel between how she felt at that point in time and how investors feel when they're on the roller coaster that our stock market can be. It's perfectly normal to have that kind of apprehension and that kind of fear. What we want to do is we want to provide the counsel and the guidance and the structures that prevent you from making decisions in the depths of that, as so many investors will, that will actually impede their ability to realize their goals. That's what we're here for, to help you realize your goals. So with that, we're going to go ahead. We're right at an hour on the call. We're going to go ahead and wrap things up. We're going to continue to do the good work that we're doing for each of you. We'll be rebalancing when your portfolios need it. We're going to continue to look for opportunities in taxable accounts to harvest tax losses, which can have real economic value to you in the future. And we'll be looking for opportunities to take advantage of the CARES Act to either suspend required distributions this year, or maybe to take advantage of Roth conversion opportunities as they present themselves. And certainly if there's anything you need or any questions you have, please don't hesitate to reach out. Even though we are honoring the stay-at-home order and working remotely, we're all still fully engaged and here to serve you any way we can. So thank you very much for participating in the webinar. We'll look forward to talking to you soon and hopefully seeing you in person in the not too distant future.
Thanks, everybody. Take care.